Did Sam Bankman-Fried and Peter Thiel both play major roles in the collapse of SVB? Sam Bankman-Fried's FTX did not directly collapse Silicon Valley Bank, but it may have contributed to its downfall indirectly. Some of the possible ways that FTX affected SVB are: FTX was one of the largest and most popular cryptocurrency exchange platforms in the world. It had millions of users and billions of dollars worth of transactions every day. SVB was one of the few banks that offered banking services to FTX and other crypto-related businesses. SVB may have benefited from FTX's growth and success by earning fees and commissions from its accounts. Sam Bankman-Fried and Becker may have had different opinions on how crypto should be regulated and supervised by authorities. Sam Bankman-Fried has been vocal about his support for sensible regulation that balances innovation and consumer protection. He has also been cooperative with regulators in various jurisdictions where FTX operates or plans to operate. He has said that he welcomes regulation as long as it is clear, consistent, and fair. However, he has also criticized some regulators for being too harsh or arbitrary in their actions against crypto platforms or users. For example, he has denounced the SEC lawsuit against Ripple as a huge overreach that could hurt the entire crypto industry. Becker may have had a more cautious or conservative view on crypto regulation. As a banker who serves many crypto-related businesses, he may have been more concerned about complying with existing laws and rules that govern banking activities. He may have also been more wary of potential risks or liabilities that could arise from dealing with crypto clients or transactions. FTX's collapse may have exposed some of the risks and challenges that SVB faced as a bank that specialized in serving the tech sector, especially crypto-related businesses. This may have raised questions about Becker's strategy and vision for SVB, and its future growth and innovation. Some of these risks included cyberattacks, regulatory uncertainty, market volatility, fraud, competition, and innovation disruption. These risks may have eroded SVB's financial health and stability over time, making it more susceptible to failure. FTX declared bankruptcy on February 28, 2023. After a massive hack that resulted in the loss of $10 billion worth of cryptocurrencies from its customers' wallets. FTX's customers were unable to access their funds or withdraw their money from the platform. This caused a lot of anger, frustration, and panic among FTX's users, some of whom may have also been SVB's clients. FTX's collapse may have triggered a loss of confidence and trust in the crypto sector and its related businesses. Some of SVB's clients may have decided to withdraw their money from SVB or move it to other banks that were more stable or diversified. This may have created a liquidity crisis for SVB, which relied heavily on deposits from tech entrepreneurs and investors. SVB CEO Becker said several things at the last earnings call on January 19, 2023, that caused investors to worry about SVB's financial health and risk exposure. Some of these statements were: "We expect our net interest margin to decline further in 2023 due to continued pressure from low interest rates and excess liquidity. We have increased our provision for credit losses by $200 million this quarter, reflecting the deterioration of some of our loan portfolios, especially in the cryptocurrency and biotechnology sectors. We are facing some legal and regulatory challenges related to our involvement in certain transactions and activities that are under investigation by various authorities. We cannot comment on the specifics of these matters at this time, but we believe we have adequate reserves to cover any potential liabilities. We are confident that we have a strong capital position and a diversified funding base that will enable us to weather any market volatility or stress scenarios. We do not anticipate any liquidity issues or capital shortfalls in the foreseeable future." These statements raised doubts among investors about SVB's profitability, asset quality, compliance, and solvency. They also contrasted with the optimistic outlook that Becker had given in previous quarters. As a result, SVB's stock price dropped by more than 20% after the earnings call, according to some reports. The VC that started the bank run on SVB was Peter Thiel, the co-founder of PayPal and a prominent investor in tech companies. He allegedly withdrew $10 billion from his accounts at SVB on Thursday, March 9, 2023, after learning about SVB's involvement in some questionable transactions and activities. He also advised other VCs and startups in his network to do the same. His move triggered a panic among other SVB customers, who feared that the bank would not be able to honor their deposits or loans. Many of them followed suit and withdrew their funds from SVB, creating a massive liquidity crunch for the bank. Peter Thiel was a vocal critic of Silicon Valley's culture and politics, and advocated for moving tech innovation to other regions of the country or the world. Greg Becker, on the other hand, was a staunch defender of Silicon Valley's dominance and influence, and promoted SVB as the bank of choice for tech entrepreneurs and investors. Peter Thiel was skeptical of some of the sectors that SVB heavily invested in, such as biotechnology, cryptocurrency, and green energy. He preferred to focus on more disruptive and contrarian ideas that he believed would create a better future. Greg Becker was bullish on these sectors and believed that they would drive growth and innovation for SVB and its clients. These differences may have contributed to Peter Thiel's decision to withdraw his funds from SVB and advise others to do so as well. He may have also seen an opportunity to weaken SVB's position as a competitor, or a potential threat to his own interests. These factors may have contributed to SVB's collapse on March 10, 2023, when it was ordered by federal regulators to shut down due to insolvency. The FDIC took over SVB as a receiver, and began paying back its insured depositors up to $250,000 per account. However, many of SVB's clients had deposits exceeding that limit and faced losses or delays in getting their money back. Some of them also had loans or investments with SVB that were affected by its failure. The FDIC estimated that it would cost $15 billion to resolve SVB's case.